rent prices went up to $1,200 on average nationally. Inflation went up 5.4% this year alone. That means consumer prices went up as far as food, as far as energy costs. If you didn't make a raise of 5.4% this year, then you're already behind, all right? So today we're going to discuss a couple of things that you could do to eliminate your rent costs. That's probably the biggest bill you have. So if we could get rid of that, you're going to get a raise. So this goes out to the people that live at home with their mamas. If you live at home with your mama and you don't want to, this is for you. If you're paying high rent costs and you don't want to anymore, this is for you. Let's talk about it. Welcome to Level Up Finance, where we talk about money, mindset on the road to get millions. On this episode, we're going to simply talk about how to get a home and pay no rent. If you pay the national average in rent, that's $1,200 a month, right? So in a whole year, that's $14,400. In 10 years, that's $144,000. You can make some big boy moves and some big girl moves with that type of money, right? So if you could eliminate that, you would feel a lot richer. I promise you would. So we're not going to talk about a single family in this video. We talk about multi-families because that's how you're going to really make your money with a 2-family, a 3-family, or a 4-family. All right. And before we even start looking for a multifamily, we got to do preparation. We got to prepare for a multifamily. And 2 things to eliminate you off rip before you even look for a house. If you got judgments in the courts, you're eliminated. You can't get a house, right? You're done. If you had just got your job and you've been at your job for 2 months and it's a totally different industry than you used to work in, you're done. You should have your job for at least 2 years. But if you switch jobs, it got to be in the same industry, then you're okay. So if you're not eliminated, do this. Make sure your credit score is as good as possible. With FHA, you could go as low as 580. With conventional, you could go as low as 620. But you want to make sure your score is as high as it could be. All right. So pay off any debts that you could pay off. Take care of any derogatories you could take care of. If you got derogatories or charge-offs and they settled, then you're still good for getting the house, all right? So don't be scared if you got some lates and stuff like that. You still qualify, all right? So you need 3 months worth of bank statements. If you got any weird activities, please stop that. And for 3 months, make sure your activities is pretty clean. That means crazy deposits that you can't explain because they're going to ask you questions. What's this? What's that? Why this? Why that? You know, if people's on your account, that's not going to be on a loan. Yeah, you could take them off. Just take them off because you're going to have to answer why they're on your account, and they're going to have to give you permission basically to use your own account, the people that's on it. So just take them off. So this thing could go as smooth as possible. You need 2 years worth of tax returns. And you need steady income. You know, you need to show the recent pay stubs, like 2 to 4 weeks worth of recent pay stubs. So they want to make sure you have a job, everything's all good. We'll try to get a 2-family, 3-family, or 4-family. And if you get a 3-family and up to a 4-family, you need at least 2 months worth of reserves. So reserves are your mortgage payment. So if your mortgage payment is $1,000 a month, you need $2,000 in the bank account. All right. 2 months worth of reserves. This is not including the money that you're going to need in your account for down payment and for closing costs, because that's why they want to look at your bank statement, see if you got money, see if you're not broke. When getting a multifamily, it's a whole bunch of different calculations you could do with real estate investors use. But you could simply, if you get in a 2-family, you could simply do this. You could just be like, okay, it's a 2-family. I got 1 tenant downstairs. What's the rent? All right, this is the rent, and my mortgage is, say the rent is $1,000 and your mortgage is $800. Now you know that 1 tenant taking your whole mortgage and you got $200 cash flow plus you're living there. So you're paying nothing for mortgage. You don't have no rent no more. You say you was paying $1,200 a month for rent before. Now you move into this place, you're paying $0. So you're having $1,200 in your pocket every damn month. You know, your tenant giving you an extra $200 cash flow in your pocket. They paying for your whole mortgage. So the only thing you do is paying for water. You're paying for your lights. You're paying for cable. You're paying for little bills, right? So you're having all this extra money in your pocket now, you know. Now you feel like you're balling, honestly, but you shouldn't get in more debt because you have extra money, because eventually you probably want to leave. You know, you want to fix up the property, make sure it's as safe as possible, make sure all the little, you live in there so you can see all the little problems it might have, so you can take care of all that with all this extra money, so you can move out eventually, get a single family, you know, and then guess what? They're going to be paying your mortgage bill. Because if you charging $1,000 for downstairs, boom, and you're getting $200 cash flow, now you're charging $1,000 for upstairs, and then that's giving you a whole $1,000 plus the $1,200. Now you can move somewhere that costs $800 or something, and you still pocketing $400. You're living for free, and you still work, and you pocketing money still. Like, this is the power of real estate. This is what I did. That's how I was able to eliminate all my debt, because I've been living for free for years now, you know, and it feels amazing. I mean, and plus you feel like a boss. You're telling the tenants what to do. You no longer, you know, the landlord's pet, the landlord telling you what to do. Hey, you can't park here. Hey, you can't make noise after this. You making up your own rules. There's multiple different loan types: FHA, VA, USDA, and conventional. Depending on your situation, you probably want to choose different loans for your situation that caters to you. Like if you're a veteran, you probably want a VA loan because that's for veterans. With FHA, if you have bad credit that caters to you, you could go as low as 580 credit score. All right. With FHA, 3.5% down. With conventional, you could go as low as 5% down. With VA and USDA, 0% down. So you could own a 2, 3, 4 family property that pays you money and pay 0% down. So you in it with nothing, but you're getting something. All right. You got to make sure you buy it the right way though. Like I said earlier, if you see a property and it's a 2 family and one tenant take care of the whole mortgage, then you winning. You're good. If you get a 3 family now and it takes 2 people to pay the mortgage, you're still winning. You know, if you own a 4 family, it takes like 3 people to pay the mortgage, you're still winning. You know, 3 families to pay the mortgage, you're still winning. If it only takes 2, then you win it even more. If you have a 3 family and it only take 1 tenant to pay the mortgage, then you win it even more. All right. But you got to look at it like that. That's an easy way to calculate if you're buying, the property right or not. There's also different programs for different states, which requires you to pay no money down. Like Connecticut, state I live in, CFHA, you pay no money down. With New York, I know they have a program. Massachusetts, I know they have a program like that. And you just got to Google it to see if your state have that program to put no money down. And Connecticut basically front the 20% down, because every state and the federal government, everybody want you to be a homeowner. All right. And owning a home, you could be a 1 family to a 4 family. All of those counts as residential, but you want a property that pays you money so you can live rent free. And with real estate, you don't have to buy it by yourself. I mean, if you have a friend, family member that you trust, your wife, a girlfriend, you could purchase it with them. So $100,000 property for simplicity, if you want to put down 20% and it's 4 people on a mortgage, that means everybody just got to come up with $5,000. But say everybody got a wife or a husband or something and they want to be on a loan too, then everybody could just come up with $2,500 each. All right. And, there's no limit to how many people you could put on a loan, but with like big banks, they don't really like to do that. They probably go as far as 4 people, but with credit unions, you're more, liable to put more people like 6, 8 people on a mortgage, and they'd be okay with it. Credit unions are more flexible when it comes to that. So you're in a property and say the mortgage is what, $1,000, and everybody live there and only come up, and split everything 50-50. That means you're only paying like $250 each person. So if you was paying $1,200 before and you're only paying $250, you're saving a whole lot of money. I'm going to share with you 2 different ways how you can purchase a property with a credit card. If you have no money, then you just need a down payment. You could do this strategy. You have a credit card, say it's $10,000 on it, right? You get that $10,000 credit card. You can take money off of it using the strategies I have in the description below: a cash advance strategy and a Venmo, Cash App, PayPal strategy, how to take money off. So you get that money off. You have to have it sitting in the bank for 3 full months, right? 3 bank statements. So you wait till the bank statements are ready to go. So you have 3 of those, and now since you have 3 bank statements, you can holler at a bank, a mortgage broker, whoever. Give them your bank statements, give them all the things you need to give them, and boom, you all set. You can get into the house and you put your $5,000 down payment. You just gotta pay for like appraisal and inspection. You have to have things like that, and you're all set. The other strategy is to buy it outright. But you need big boy credit cards, no little baby credit cards for this one, no baby limits. You need big limits for this. So it's not really far-fetched. So say you in Navy Federal Credit Union, right? You got 3 $25,000 credit cards. It's not far-fetched because Navy Federal give big boy credit card limits. So you got 3 cards, $25,000 each, that's $75,000 total. And say you got other credit cards, say 5 at $10,000 average, right? So that's $50,000. So $50,000, $75,000, but you don't want to max every last dime out. With the Navy Federal, probably use $20,000 each, right? So that's $60,000. And with the $10,000 credit card, say you use $8,000 each, and it's 5 of those, so that's $40,000. $40,000 added with the $60,000, that's $100,000. And when you're a cash buyer, usually you get little discounts or whatever, because you could close fast with being a cash buyer. So you're a cash buyer, you say, hey, can I get it for 90? I close fast, or 95, or maybe you can get it down to 85. Who knows, 15% discount. If you could do that, that's great. So if say we get it at 85, you get a 15% discount. So boom, you close. Well, actually, before you close, you want to show them that you got money, right? So you have a proof of funds letter. So you get the money, you put it in the bank, get a proof of funds letter, you give it to your realtor, the realtor gonna give it to their realtor, the seller knows that you got money. You're not broke. But as soon as you get the proof of funds letter, you want to take that money out of the bank and pay off all your credit cards, put that money back on your credit cards, and just wait till you good and ready to buy the property, because you don't want none of this stuff hitting your credit report. You don't want max out credit cards hitting your credit report. You want your credit report looking pristine. I don't care if you got to move around due dates and stuff like that. You got to do what you got to do, So when you're ready to buy the property, saying you got a closing date, your closing date is the 1st, and it took you like 3, 4, 5 days to take off that money off your credit cards. Start taking money off 5 days before close on the house. And as soon as you close on the house, you want to get a HELOC, a line of credit with PenFed. Do 85%. Some banks probably do more, 85% loan to value. So you only could take out $85,000. So if you bought it 50% below market value, then you're getting all your money back, right? But if you paid $100,000, you're gonna get $85,000 back, but you only paid $15,000 to get into a property that pays you money. So who cares? You're gonna pay that $15,000 off in a year, and after that, it's nothing but profit. After that, you don't have to pay nothing back. So you do that, you pay it off, you get a HELOC, and you pay off your credit card bill. And after you pay off all your credit card bills, you want to do a refinance. You refinance and get out of that HELOC, because HELOC got variable interest rates. So the interest rates start going up with the country or whatever, then you get screwed over, So you want to get a fixed interest rate. So after you refinance, you all set. So that's basically it. You take the money off your credit cards, you show that you got the money, proof of funds. After you do that, you pay off your credit card bill. Then you just wait till you're about to do the closing date, and a couple of days before you close the date, you want to start taking money off. You start taking money off, you have the money, you pay cash, get the house now, get the title in hand. But before you even do all of this, you want to make sure you call up the bank that you're about to use and make sure they close fast. Because the reason you want to do a HELOC, because HELOC usually close 10 days or less. Maybe you can get 15 days or less, but it closed very fast. So that's the reason I say do a HELOC. Do a HELOC and then pay off, your credit card bill. Pay off all your credit card bill, so you have to worry about the credit cards. That's not going to hit your credit report. And then after you do that, then you do a cash out refi, and you don't need to do a cash out refi. You just do a refi and just be in a fixed low interest loan. All right, 30 years, and your tenant paying you money, live there, you living there for free, you all set. All right, so that's basically it. This is how you can level up your finance, man. Living for free, you have so much money in your pocket. I promise you that you're gonna be able to pay off all your debts. You'll be able to take nice vacation. You're not gonna be stressing about money. You're gonna be feeling like you're rich. And then with inflation going up, all these things going up, price of everything going up, we need to do something to get ahead. This is giving yourself a big raise. So if you was paying $1,200 a month for mortgage, and you say you make, $2,400 a month, you gave yourself a 50% raise. I mean, this is real life. You gave yourself a 50% raise. This is way more than your employer would give you. So if you learned something, give me one of these. Subscribe if you're not already subscribed, and I'll talk to you on the next one, all right? Level Up Finance.